All right, let's just dive right into this ultimate exam prep explainer. If you're a taxation student looking to absolutely master the precise rules of employment income and get totally ready for your exams, well, you're in the exact right place. We're going to break down the Inland Revenue Act provisions step by step so you can confidently tackle literally any question they throw your way.
So, here's our roadmap for today. We're covering 4 main areas. First, defining employment income. Second, taxable versus exempt income. Third, valuing non-cash benefits. And finally, key assessment rules.
Kicking things off with Section 1, defining employment infirm, the statutory foundation. Now, the absolutely crucial point here is that according to Section 5, employment income is all gains and profits derived from an individual's employment for a year of assessment. Basically, it covers every single thing you receive for the service you render. It really doesn't matter if it's cold hard cash, like your monthly salary and bonuses, or non-cash perks, like a company car. It all counts. Think about how all these professional relationships connect. Anything that falls outside this professional network simply falls outside the scope of employment, so it isn't taxed here. For example, if you get a benefit on purely personal grounds, say a birthday gift from a friend or a personal donation, that is completely off the table for employment income. The income literally must be for services rendered. Moving right along to Section 2, taxable versus exempt income, the in or out paradigm. You know, in an exam setting, quickly categorizing line items is honestly half the battle. Think of it like a giant sorting mechanism. When you're staring down a tricky question, remember your basic wages, living allowances, and reimbursements for your personal expenses are clearly in. But watch out for Section 5.3. It has specific exclusions. If your boss reimburses you for a company expense you paid out of pocket, or if they give everyone on staff the exact same medical insurance on equal terms, that is out. It's not taxable employment income. You absolutely want to memorize these highly testable third schedule exemptions too. Things like compensation for death or personal injuries, government pensions, and approved Provident Fund retirement payouts, those are completely shielded from employment tax. When you spot these in a scenario, you can just confidently exclude them from your final taxable income figure. So calculating tax obviously involves way more than just looking at the base salary figure. Cash is really only part of the story, which brings us to what is arguably the trickiest part of the whole exam, figuring out exactly how to tax the things that aren't money. That brings us to Section 3, valuing non-cash benefits, the math sequence. It's kind of fascinating because the law literally forces a subjective perk, like, say, a nice apartment or a free meal, into an objective, hard monetary value. But before we actually do the math to slice up this benefits pie, we really need to nail down the fundamental legal rule for sizing up these non-cash perks. You've got to commit this 2-step process to memory right now. Step 1, you always look for the fair market value of the benefit first. Step 2, only if you cannot ascertain that market value, then you fall back on the cost the employer actually incurred to provide it. So remember, market value first, cost second. Okay, let's test this with a scenario straight from the source material. Imagine Miss Carter gets 100,000 shares from her employer under a share scheme. The market value is 12 rupees per share, but she gets a sweet discount and only pays 10 rupees per share. So, how on earth do we value that benefit for her employment income? Well, the answer is the excess of the market value over her contribution. That means a taxable benefit of 2 rupees per share. To finish the math, you take that 2 rupees, multiply it by the 100,000 shares, and boom, you add 200,000 rupees to her taxable income. Now, let's talk about housing, because you absolutely must memorize this table for the exam. When an employer provides a residence, the value of that benefit is calculated as a strict percentage of the employee's monthly cash salary. And the crazy part? It depends entirely on where the property is located. It's 12.5% for rated areas, 10% for unrated areas, and 7.5% for estate bungalows. All right, time for another quick knowledge check. Let's apply the rule we just learned to Miss Olivia Bennett. Her cash salary is 400,000 rupees a month, and she lives in a company-provided apartment in a rated area. Think you can find her taxable housing benefit? Since the apartment is in a rated area, we take 12.5% of her 400,000 rupee salary. That gives us 50,000 rupees a month. That 50,000 gets added directly to her taxable employment income every single month. Vehicle benefits are actually a bit simpler because they often just use flat monthly rates. Providing a vehicle is a flat 20,000 rupee benefit, a driver is 10,000, and fuel is another 20,000. But, tax laws absolutely love their exceptions. There is a very specific exam caveat here. You have to watch out for the 25% rule if the vehicle is provided under a specific government circular for official use. You're going to want to take a mental screenshot of this cheat sheet for the exam. This covers all the other non-cash benefits. Notice how things like free meals and medical benefits are valued at 100% of the cost. Meanwhile, loans on concessionary interest rates, they actually add 0% to the tax bill. And if your company pays your phone bill, you just add exactly 50% of that cost to your taxable income.
All right, last but not least, Section 4, Key Assessment Rules, the timeline of taxation.
So we really need to look at the critical timeline rules that dictate exactly when an employee is liable to pay tax on these amounts. Honestly, getting the year wrong on an exam is a guaranteed way to lose easy points. According to Section 21(2) of the Inland Revenue Act, employment income must be accounted for purely on a cash basis. This is a huge shift from business income, which often uses accrual. For employment tax, it literally only matters when the money physically changes hands.
Let's see if you can avoid a classic exam trap with Mr. Neemal's bonus scenario. Say he gets a 600,000 rupee bonus in May 2025. The company earned the profits for that bonus way back in the previous year of assessment, 2024 to 2025. So, is he liable to pay tax on this bonus for the 2024/2025 year?
The answer is unequivocally no. Because under the cash basis rule, he is only taxed in the year he actually receives the money, which, in this case, falls into the next year of assessment. It totally ignores when the company earned the profits. Rule of thumb, always, always follow the date of receipt.
We're going to wrap up with this quote from Vivian Green. Life is not about waiting for the storm to pass, it's about learning to dance in the rain. I really hope this explainer helps you dance right through your taxation exams. But as you go out there and master these rules, I want you to ask yourself, as the modern workplace evolves with remote work, crypto payments, and wild digital perks, how long will it take for these rigid tax laws to actually catch up to reality? Keep studying and you're gonna do great.